I already covered what I am going to tell you in options, what strategies. Next video I covered basic of options, what are the basic ITM, OTM, ATM, strike price, call put, and application of option. Now I am going to cover volatility. Volatility is very important in options because option is based on volatility. If you are not aware of volatility, you will not able to trade options. First you must know the technical analysis, basic technical analysis, then you must be aware basic of options, then volatility. Because in upcoming strategies you have to see, you have to analyze whether it is a significant volatility or it is a high level of volatility or it is a low level of volatility. Volatility is the, let's go with the definition of volatility. Volatility is the degree of variation of price time series such as the closing prices of particular stock. This is measured standard deviation of time series, a statistical measure of disbursement. Volatility is not concerned about direction of change but amount of change, how much amount it is getting changed. There are three types of volatility in options. First is historical volatility, the second is implied volatility, the third is realized volatility. So let's go historical volatility. Historical volatility gauges the fluctuation of underlying securities by measuring the price change over predetermined period in the past. The second is implied volatility. Extensively used in option trading is implied volatility. In the context of options, the implied volatility indicates the extent to which the return of underlying asset may fluctuate between now and the expiry date of options. The higher the implied volatility, the more people think the price of underlying will move a lot of asset. So implied volatility, if high, then the price of stock will move a lot. Then the third is realized volatility. This tells us expected variations in future time period. Realized volatility tells us actual volatility realized for the future period of time. Naturally, you can calculate the realized volatility only after the future time period. So you can calculate for the future time period. So let's go ahead, implied volatility. So what is implied volatility? We already covered. Implied volatility is a metric that captures the market view of likelihood of change in a given security price. Investor can use is to project future moves and supply demand and often imply it to price option contract. Implied volatility is not change the same as historical volatility, also known as realized volatility or statistical volatility. The historical volatility will measure the past changes and their actual values. Let's go at what are the takeaways. Implied volatility is the market forecast of likely movement in security price. Implied volatility is often used to price option contracts. High implied volatility result in options with the higher premium and vice versa. Supply oblique demand and time value are major determining factor for calculating implied volatility. So these two are major factor. Supply demand, this is economics factor, then time value. These two will use to get it implied volatility. Implied volatility increases in bearish market and decreases in bullish market. If market is going into bearish mode, this will increase, and if market is bullish, then implied volatility decreases. This you have to remember, it is very important point. Implied volatility and options. So let's correlate implied volatility and options. Implied volatility is one of the deciding factor in price of options. So first thing is buyer of option contract. Let's holder buy or sell an asset at a specific price during predetermined period. Implied volatility approximates the future value of the option, and the option current value is taken into consideration. Option with high implied volatility will have higher premium and vice versa. Second thing, it is important to remember that implied volatility is based on probability. It is only an estimation of future price rather than the indication of them. Even though the investor takes implied volatility in account when making investment decision, and this dependence inevitably has some impact on the price themselves. There is no guarantee that the option price will follow the prediction pattern. However, when considering an investment, it does help to consider the action other investors are taking with the option, and implied volatility directly correlated with the market opinion, which does in turn affect the option pricing. Implied volatility also affects the pricing of non-option financial instruments such as interest rate cap, which limits the amount and interest rate on product can be raised. So this is the impact of implied volatility on the options. This way decide the price of options. Factors. Which factor are affecting the implied volatility? So just with the market as a whole, implied volatility is subject to unpredictable changes. Supply and demand are major determining factor for the implied volatility. When the asset is high demand, the price tend to raise. So does the implied volatility, which leads to an higher option premium due to risky nature of option. The opposite is true. When there is a plenty of supply but not enough market demand, the implied volatility falls and the option prices become cheaper. Another premium influencing factor is the time value of option, or the amount of time until the option expires. A short dated option often results in low implied volatility, where long dated option tend result in high implied volatility. The difference lays in the amount of time left before the expiration of option contract. Since there is a lengthier time, the price has extended period move in favor price level in comparison to the strike price. So pros and cons of using implied volatility. So pros and cons. Implied volatility helps to quantify market sentiment. It estimates the size of movement an asset may take. However, I mentioned earlier, it does not indicate the direction of movement. Option writer will use calculation using implied volatility to price option contract, and also many investors will take IV when choose an investment during period of high volatility. They may choose to invest in safer sector and products. Implied volatility does not have basis of fundamental underlying the market assets, but it is solely based on the price. Also, adverse news events such as wars or natural disaster may impact the implied volatility. Please remember this. So pros, properties, quality of quantifies market segment, uncertainty helps set option price, determines trading strategy. Cons, based solely on the prices, not on the fundamentals, sensitive to unexpected factors, news event, predicts movement but not the direction. So volatility impact options in the above mentioned chart. Option type: rise implied volatility, fall implies volatility. Long call positive, then implied volatility is in fall negative, short put negative, implied volatility rise then negative, fall positive, long put it is positive negative, short call if implied volatility rise then it is negative, when it is falling it is positive. So this is the relation. Let's go ahead with the option payoff. The optionally characteristic of option result in non-linear payoff for the option. In simple word, it means the losses of buyer of options are limited. However, the profits potentially unlimited. For the writer or seller, the payoff is exactly opposite. His profit are limited to the option premium. However, his losses are potentially unlimited. Payoff of the option. There are 5 to 6 payoff of the options. First is payoff profile of buyer of option long asset, payoff profile of seller of option short asset, payoff profile of buyer of call option long call, payoff profile for writer or seller of option short call, payoff profile for buyer of put option or long put. So payoff profile of buyer of call option long call. A call option gives the buyer to buy the underlying asset on the strike price in the option. The profit oblique loss the buyer makes option depend upon the spot price of underlying. If upon the expiry the spot price exceeded the strike price, he makes profit. Higher the spot price, more is the profit makes. If the spot price of underlying less than the stock price, he get option unexercised. His loss in this case is a premium paid for buying the options. Payoff profile for writer or seller of call option short call. A call option gives the buyer to buy the underlying asset of strike price is specified in the option. For selling option, the writer of the option charges the premium. The profit and loss that the buyer on the option depend upon the spot price of the underlying. Whatever is buyer profit is seller loss. If upon the expiry the spot price exceeds the strike price, the buyer will exercise the option on the writer. Hence the spot price increases, the writer of the option start making losses. It is reverse of the previous. Higher the spot price is losses he makes. If on the expiry the spot price of underlying is less than the stock price, buyer lets his option expire unexercised and the writer gets keep the premium. Payoff profile for buyer of put option long put. A put option gives the buyer to sell the underlying asset at a stock price specified in the option. The profit loss that the buyer make on the option depend upon the spot price of underlying. If on the expiry the spot price is below than the stock price, he make profit. Lower the spot price, more profit he makes. If the spot price of underlying is higher than the stock price, he lets his option expire unexercised. His loss in this case the premium paid for buying the option. So the last is payoff profile for writer or seller of put option short put. A put give the buyer to sell the underlying asset at the stock price is specified in the option. Selling the option, the writer of the option charges premium. The profit oblique loss that the buyer makes on the depends upon the spot price of underlying. What is the buyer profit is seller's loss. If the option expiry the spot price happens to be below the stock price, the buyer will exercise the option on the writer. If on the expiry on the spot price of the underlying is more than the stock price, the buyer lets his option exercise and the writer to keep the premium. So friends, this I covered. So you have to I covered first thing volatility. Then there are 3 types of volatility: historical, implied and realized volatility. The next definition of implied volatility, what are the key takeaways, implied volatility and option relationship. Implied volatility is one of the deciding factor in pricing of options. Then what are the factors affecting the implied volatility, pros and cons using the implied volatility. Then pros, what are the properties and what are the cons. Then option, how option work, implied in a implied volatility के IM means implied volatility. Then option type, short put, short call, long call, and how it is, if it is implied volatility rising, then or implied volatility is negative, then how it is impacting long call, long put and short put. This you have to remember and understand. You must develop your skill to understand these things. Then what are the payoff of option? These are non-linear payoff. This you have to remember, because based on this I am going to cover the strategies. The first is payoff profile for buyer of asset, long asset, payoff profile of seller of asset, short asset, payoff profile for buyer of call option, long call, payoff profile for writer oblique sell bracket seller of call option, short call, payoff profile of buyer to put options, long put, payoff profile of writer of seller of put option, short put. So friends, you must understand this is the basic. So whole I am telling you, now I will go ahead in strategies. So you must remember this thing what I told you. The first I already covered. I will again go into the PPT basic of options. I must go it, because without this you will not be able to understand. First thing, what are the index option, stock option. Then what is option, you must understand. Then call option, put option, stock price. Then I already covered in earlier video what are American option, European option, option premium, intrinsic value, then time value, then the exact definition of ITM, ATM and OTM. Then buying, selling of call and puts. Then speculation, hedging, how option work, then option risk. This is the basic I already covered. You must go through each and every line and try to understand. Option is based on this, because without this you will not able to understand strategies. So then you must understand what I covered. So I covered 2 chapters on the option. Please go through 4 or 5 times, and you must be using this to make the strategies. After this video I am going to cover indivisible strategies of option. Please try to understand, go through this thing 4 5 times, 6 times, and try to understand terminologies. Please subscribe video. In case of not subscribe, please forward to friends who are doing trading on options. Please remember, there is no strategy in option without hedging. Option is used for hedging. So share these videos to your friends, and for in case of query or support, I have already shared my mail ID Satyendra Singh 311976 @gmail.com. Mobile number and WhatsApp number are same, 9873938781. Please be in touch. Let's try to be understand option. I will try my best for your learning purpose, but I am again saying you must have proper technical analysis knowledge before trading. So please go through technical analysis videos, try to understand at least basic indicator, so you will able to correlate with the options. So friends, this is what from my end. Thank you. Good night. Have a nice weekend.